One of my absolute favorite things about rental property investing is how many ways you're actually making money on a rental property. There are actually 5 different profit centers on a rental property, meaning you're making money in 5 different ways. A major advantage to this is that if one of the ways or a couple of the ways those income streams get hindered, in theory, you should have some other income streams kind of keeping you afloat or helping balance that out. So at any given time, you're making money in up to 5 different ways. So let's talk about those briefly. To help and to give you a visual so you can actually see the 5 ways themselves, I'm going to share my screen here and type them out as we go. All right, the profit centers on a rental property. Number 1, cash flow. Who doesn't love cash flow? So the cash flow means when you own the rental property, you have expenses on that rental property, obviously, and tenants are paying rent. That's the income. If you subtract the expenses from the income, whatever's left over is your cash flow. Hopefully, you bought a smart rental property and you're in positive cash flow, meaning the income is more than the expenses. There are negative cash flow situations, and quite honestly, there's probably more negative cash flow situations than positive, meaning the expenses to own that property outweigh the income, so you're actually losing money every month. So as far as an income stream, this one, as all of them, could be positive or negative, but hopefully you're making positive cash flow on your rental property. So this is the money that you're pocketing every single month. Number 2, which a lot of people are familiar with, is appreciation. Appreciation is when the value of the property goes up. So let's say you pay $100,000 for a property and suddenly it's worth $150,000 for whatever reason. That $50,000 increase in equity is your money, period. And what's really cool is if you finance the property for $100,000, that's still all you owe back to the bank, not $150,000. So that $50,000 is cash in your pocket. Fantastic. The thing to know about appreciation is that it is speculative. A lot of people assume that every single property is going to appreciate all the time. It's not always true. It's speculation. Ask all the speculators how they felt with the 2008 crash. Not good. So you have to be very careful of appreciation, but when appreciation happens, it's fantastic because it's like free money in your pocket. Now, cash flow and appreciation are the 2 that are kind of obvious for everybody. Now we're going to get into the less obvious ones. Number 3. Tax benefits. This comes in, well, I guess kind of one form, and this is unofficial and it doesn't happen all the time, but quite often the income from a rental property ends up being tax-free because one of the residential rental property asset class, if you think about that, is one of the most tax-advantaged asset classes in the entire tax system. The write-offs that you can write off on a residential rental property are so vast that often the write-offs end up completely negating the income. So you essentially end up not having to pay income tax on the income you received. Again, talk to your accountant. This is not for every single case, but for a lot of cases, rental property income does end up being essentially tax-free because of the degree of the write-offs. There are a whole bunch of details. Depreciation is the big one, but just know that you can end up with tax-free income. Now, when I first started buying rental properties, I was actually getting higher refund checks because the write-offs were so big that I was actually making more money on the tax benefits. So you could either actually put money in your pocket from the tax benefits, or it could also be at least that you're saving what you would normally have to pay in taxes, which if you think of like 1/3 of your income is a lot. So tax-free income in of itself is an income stream, which is an awesome one. Number 4, building equity via mortgage paydown. What the heck does that mean? So when your tenants are paying rent on the property, their payment is covering your mortgage. So let's say that you buy the $100,000 property and over time, 10,000 of it has been paid down through your mortgage payments. So now you only owe only 90,000 is left. Well, you weren't the one paying that mortgage payment. Your tenants essentially were. I mean, you were paying it, but it was their money. So that $10,000 of now equity in your property is your 10,000. See what I mean? So, hello. I mean, you could argue that if you pay all cash for the property, that would have been come to you in cash flow form, whatever. Most people finance. So if over time the property gets paid down to $50,000, you now have $50,000 in equity in the property that it wasn't your money that paid it down. Does that make sense? I hope it does, because it's a huge advantage. And especially by the time you pay off the property, you have the entire amount of equity available. The last one, which is not all that obvious as a profit center, is hedging against inflation. This is a longer, more complicated explanation, but just understand, think about, what is inflation? The value of the dollar becomes less. So if you buy a property in 1980 prices, for example, and it's now 2020, so 40 years, are we 40 years from 1980? Ha, a little mind blow there. 40 years later, inflation has been going the whole time. Well, guess what? You only paid $1980 for that property, but now it's worth $2020. Does that make sense? So owning rental properties is one of the few ways to actually have inflation work to your advantage. The more inflation happens, the more valuable your property is. Hope that makes sense. These start to get a little bit more complicated to explain, but now let's go back through these. Number one, monthly cash flow. This is cash in your pocket if you have a positive cash flow property. Number two, appreciation. The value of the property is going up over time, or for market reasons, or for whatever reason. Tax benefits. Most advantageous tax class in the tax classification system. Equity billed via mortgage paydown. Your tenants are paying your mortgage payment, that equity stays in your pocket. Hedging against inflation. Inflation works wonders for rental properties. So what's really cool about this is you are, again, like I said earlier, if one of those income streams falters for some reason, you have the others to carry you on. I had a rental property one time that, for reasons beyond my understanding, was vacant for 10 months. I started freaking out. My cash flow was negative. I'm paying the mortgage payment, and it was like, I hate real estate. And I sat down with a mentor of mine, and we kind of broke down these profit centers. And what we figured out is I was making so much through the rest of them, particularly in that case, the property had already appreciated $40,000 in like 3 years. That's not a standard case, but in that case, it happened to be the situation. So was I really losing on this property? Heck no. I was profiting like crazy from this property, but it was from the other income streams while the cash flow was hindered. So hopefully that gives you not only a better understanding of how you make money on rental properties, but also gives you some motivation and excitement to get really pumped about rental properties, because there's a lot of money to be had in them. Again, assuming you buy correctly, which is you've got to learn how to do that. You can't just buy any rental property and be fine with it. But, you know, that's it's kind of some exciting stuff.